Hey everybody, Preston Bryn here with our weekly roundup. This is for the trading week ending February 5th, 2016. What I've got on the screen here is a weekly chart of the E-mini S&P 500 futures. I wanted to step back out again and just kind of give everybody a perspective on where we are and what the price action seems to suggest. I don't care what business show you watch during the week or weekday mornings or on the weekend. You can find a panel of hosts that half of them will say we're going up and another half of the panel saying we're going down. And then you've got the extremes. You've got one or two that say we're going to go up from here 20 or 30% before the end of the year. And you got a few that say we're going to go down to, in the S&P 500, 500 or 600, extreme move down. So there's certainly that group of people out there. But for us, the best way to really draw a bead on the market is just pay attention to price action, guys. That's at the end of the day, it doesn't matter whether the government report is and seems great or not so great. You've got to follow price action. Price action will tell you the mood and sentiment of the market based on the reports and the results that come out. Sometimes that's why you see a beat on the numbers and the market sell off, or sometimes you see a clear win on the markets or a clear loss on the government report, and then the markets they go up. So price action is going to tell you where you need to be. So looking at price action on this weekly chart, you can see here, and I've showed this many times before, and it's still holding true to form right now. I've got a Fibonacci retracement on this, and this goes all the way back to the lows made on March 9th, 2009, and the highs made back in the middle of May 2015. And you can see that and this is a weekly chart, so each bar represents 1 week in time. You can see that the initial pullback zone here of around, call it 1787, 1790 area, to me is still very much in play. And I believe we're gonna kiss that zone there. You can see right here we've had a little bit, and I'll zoom in a minute, but you'll see here we moved up just a little bit. But again, back in August of 2015, you can see we moved up a pretty good bit, and then we gave it all up and came right back down again and pretty much touched right around the lows. So I would expect a little bit of a give coming back down here and then testing this area again. And then from that point, we got to take a look at volume, take a look at volatility, and see what it's telling us. And by the way, we'll look at volatility here in a minute. But, like I told our members, as we were moving up this channel right here, and my lines aren't exactly straight, you can see we were doing it on reduced strength. And then finally, when we hit a second attempt at the highs at 2134, right here, we were well off the highs here, and eventually we just gave it all up. And you can see the strength meter coming down right here like that on that August 24th low. And we haven't had the strength here pushing the markets down since 2011. And you can see if I were to draw a line here, it's roughly about the same. We're about, when we hit the lows in 2011, on this nice bull market run that we've had since March 2009. So this to me suggests we're going to pull back a little bit more. In fact, if we look at the Elliott wave count on this weekly chart, you can see a 3-leg, a 4-leg, and then a 5-leg high, which confirms with the bearish divergence here on this. And by the way, I could call up my MACD setting, and you'd see the same thing. Would have the same look and feel here. And now we're just doing this rain dance around this key level here, 1790. And I do believe we're probably going to come back down. The odds favor it. At least the probability favors coming back down and touching that area. But you can see here that on a monthly chart, I did a further pullback, and it suggests that area is going to break, and we can come down as low as around the 1630 area. Coming down even lower to the 50% pullback here. Now, I don't believe we're going to touch that area, which is around 1400. We could see that if we get a confirmed recession. I don't believe the U.S. is going to go into a recession. I know a lot of people believe that. Perhaps maybe in 2017, I think 2016 this year, the GDP numbers are going to come in such that, yeah, they're going to be lower, but they're not going to be sub-zero. I don't see that. Not 2 quarters in a row, but enough to scare the children to get the markets down, perhaps down south of this number, perhaps, and maybe even down close to this 1573, which is the high peaks of 2007, right? And also the dot-com bubble. So I see that. I don't see us um, going lower than that. But right now, I'm calling a near term around 1790 area. Now, let's zoom out a little bit. Let's look at the monthly chart here real quick, just to give you guys another view here. So if I come back on a monthly chart, and you'll see, notice here the Elliott wave count is 345, and now we're doing this big ABC pattern, which is traditional out of an Elliott wave count of 5. And then at the end of a C leg, you generally pick a new direction. And one thing I will say, if I zoom in on this real quick here, let me just show you, and then we'll go out and take a look at a monthly. You can see here on this, on a weekly basis, you can see that this C leg here actually went lower than the A leg there. There's the A leg right there, and you can see we actually went a little bit lower from the C leg to the A leg. That suggests that we're still in a more of a downward tilt for the markets, okay? And you can see this bottom here. Now, in August 24th, I will show you that where the markets opened and closed, you can see, and I'll just circle them here like this, where the markets were opening and closing. You can see that they were all right in this area right here, okay? That's where the markets open and close. Now you got these sticks down like this, but then, you know, when the markets open for the day, trading day, these are the futures contracts, but when the markets officially open and then close for the week for the futures, you can see these were just, you know, downdrafts. Now, if we look at where the markets open and closed here on these weeklies, you can see right in this area here. So we're a little bit lower now, right, on the open and close for the week than where we were before. So we're heading in the wrong direction here. And that would suggest that, yes, we can have some candlesticks that give us these bounces up into this area here, because this is a major resistance zone up in this area here, as my members know, you know, anywhere north of 1980. We've got a major resistance area here. And I could see a bounce back up here. In fact, last year we bounced all the way up to about 2007 before we came all the way back down in a 3-week period of time down to 1860. So we came down over 140, 150 points in just a 2-week, 3-week period. So don't believe we can't bounce up and then roll back over again. In fact, the markets would indicate that is a likely outcome right now, putting us back down in this area down here. And then should that break, I've got some support zones down here that we can find ourselves. And members, I will see you tomorrow night. And I'll try and make it quick because it's Super Bowl weekend. I know we got a lot of football fans out there, but I'll cover the basics to make sure everybody knows where we're covered here on this. But that's what I'm looking at in the E-mini S&P 500 futures, guys. It looks like the question that I'd pose is the low in, and I would say right now the market price action indicates that it's not. And when I say the low end, is the low end made, and if I come down to a daily chart just to really zoom in even closer, you can see here, was this the low right here that was made on the 20th of January? And if we look at the daily chart and you look at kind of a comparison of the price action, you can see here, we came up, we came down, a little bit of a head fake, up, way up here, and then all the way back down to here, and that was a low there, right? We made a higher low before we took off, took out these key pivot highs here and attempted another run up here. But because that run failed, then I think the dynamics over here are going to be a little bit different than the dynamics over here. It's going to have a little bit more of a bearish tone to it. And you can see here, we've made a run up like this, and now we're in like right here. This is where we are right now, where we've closed. And, you know, we could probably dip down a little bit more. We got a lot of support right in this area here around the 1850 area. And then I could see us possibly coming back up, maybe taking out that pivot high there, right around 1940. This is the E-mini futures, and then boom, we give it up, and then we have a couple of really hard down weeks, and we come down and test these lows here. And then depending on the volume and the price action as we come down here, that'll give me an idea of, based on the results, is this going to be a pretty much firmed up low similar to this, and then we make another run back up into this area here again. Right now the price action says that the low is not in, and that we're going to move a little bit lower here. Okay, so that's kind of what I'm looking at as I look at the E-mini S&P 500 chart. Now, if we come out here, as I said, I'll show you the monthly chart here real quick. And it really takes it out, and it kind of just puts everything in context. We're still in a secular bull market, all right? Cyclically, we could actually go into a bear market, which is a 20% drop. And as I showed you guys, I think last week, what's a 20% drop off these highs here look like? And that puts us right around the, let's call it, I get as close as I can, right about there, maybe around the 1700 area, roughly. Not much, not much higher or lower than that. So that would be, and that's a major area there of support. It's a psychological barrier, and we could still be in a bull market, if we go in that area, because if I come down here and I just put a trend line up here like this and run it like that, okay, we would have to break this trend line. If we break this trend line to the downside, then that really improves the odds that we're going to come down and go into a bear market, yet on a secular basis still be in a bull market, all right, longer term. But this does suggest that. And the other thing that my chart does seem to indicate here, let me just move this out of the way here a little bit, is that on a monthly chart, it's suggesting that the potential pullback here is going to be around this area here, just north of the 1573 area. Say call it 1614, 1615. Because notice on a monthly chart, we got a 1 leg, a 2, and a 3, which would suggest a 4 leg somewhere in here before we make our final 5 leg here, and then we come back into another wider, longer term ABC pattern again. So, this does suggest that we are not done yet trying to find a bottom. But, the one thing that I also find very interesting on the charts, and there's a lot of mixed signals coming out of economic reports, which is why you can't really follow that. You got to follow the price action. Otherwise, I promise you, you're going to be lost and confused. The past 2 weeks was a very difficult trading environment for swing traders. You want to be in a trade anywhere from a couple of days to maybe a week or two, or a position trader you want to be in for a month or 2 to 6 months, or even a year or longer. Very difficult because the markets have moved dramatically both up and down, and during the course of the day, we haven't gone very far at the end of the day, but we've just moved dramatically. If I look at my average true range here, which is the measurement of a daily move over the course of a period of time. In this case, it's a monthly chart. You can see here that the true range of the E-minis up at this level here is, very similar to the levels right here. And remember, when we were here, we were a lot lower in price than here. So on a percentage basis, these moves were much larger, right, as a percent of the range here. But we're moving roughly about 123 S&P points in a given 4-week period of time. And a lot of that is chop, up and down, up and down. It doesn't mean 123 points down or 123 points up. It just means the range. We've traded within about 123 point range. Now, if I were to come in and let's take it on a daily basis, and you'll see even on a daily basis, it's very high. Look at this. On a daily basis, last August, and the prices are similar, so it gives us a better comparison. You can see last August, we're almost right where we were last August as far as the daily range. You can see if I draw that line just like that. And we're averaging on a daily basis about 44 S&P points on a day. So that's the range of movement. So on a daily basis, this is a great environment for day trading. For those of you that are just taking short-term trends up and down, buying the bottoms, selling the tops is a pretty good way to go. But position trading or swing trading, probably more appropriate over a 5-day to a 2-week period. It's very, very difficult. Weekly options are very difficult here just because of the wide swings. You go up and you think you're in the money, and then you go right back down again and you go right back out again. It's very hard to hold a position, but day trading is a really great environment right now just because of the way the markets are moving. But that just gives you an idea of the E-mini S&P 500 and just some of the confusion that the markets are reacting to based on the price action that we're seeing. Now, I'm going to show you a chart that's better than the S&P 500. If we look at the Dow futures, now the Dow futures, you can see here, we've actually come down. And let me just change this so you can see it better here. Let me just extend the prices over here like this. Let's go close over here like that. All right, so well, let me just, let's try it like this. Bear with me 1 minute. And let me just get this here. So let's extend them like that. And then let's just move it up a little bit bigger so you guys can see a little bit better like that, and we'll bold it. All right. So now you can see right here on the the Dow, we've already come down to our 23% fib. And the other thing in the Dow is that we did not go as low as the August low of 2015. We actually came a little bit better off than that, unlike the S&P. So the Dow is the stronger of the group. Now that doesn't mean it's not going to go down further and probably test this area again, which I think it will. But it's holding up a lot better, okay, than the others. And the one that is the subpar performance, if we go look at NASDAQ, over the past 3 weeks, NASDAQ was the best performer going towards the end of 2015. But if we look at the NASDAQ futures, which is 100 of the largest futures in NASDAQ, I mean, the movement here is really tremendous. If you look at this weekly chart here, we have not made new lows, right? You can see it's holding up, but the NASDAQ has given up more over the past few weeks than all the other indexes. And if you look at the daily, you can see here just how fast NASDAQ has given it up. I mean, just boom. And you can see right here, we're coming all the way back down on Friday's close, because the NASDAQ on Friday was down 136 points. That is a huge move. You can see the daily movement in the NASDAQ futures, over 116 points, guys. Again, a day trader's dream. It's $20 a point in NASDAQ 100 futures. Now, I do believe we're going to go a little bit lower. We may have a bounce going into early next week, and then we may see another roll back over again. So that is something that we're really watching very closely. The other thing that I'm watching is the transportation index. You can see right here on the transportation index, you can see the 2016 open, you can see the 2016 low. You know, since the third week of January 20th, the transports have actually been moving up. And we do want to see some strength in it, but it's suggesting that this is going to roll back over as well and possibly make new lows in 2016. The other one that I want to show you is, let's take a look at bond market. The bond market really just had a strong day Friday. You know, risk is still coming out of the equity market and going into bonds. You can see here we're near the 2016 highs in bonds right now. You can see the opening price here in blue around 153. And we're up at 163, so that's 10 full handles, which is $10,000 per bond contract to the upside here. Just a huge move up. In fact, we took out the highs made in August when we had that very fast down move in August. Just boom, we've just, and it's been very steady and very orderly. It's not like a panic. We've just been slowly moving money out of risk into risk-off environments. And you can see the highs made in the bond market back in March of 2015 or April of 2015. We're marching back up there. In fact, my chart is indicating that we can literally over the next, going into the summer months, have the bonds possibly up around 170, which would bring interest rates in the 10-year extremely low. And speaking of interest rates in the 10-year, if we look at them, you can see right here the interest rates finished at 1.84. Now the line of demarcation is around 2%. Anything below 2% is kind of viewed as a risk on, risk off demarcation. In fact, let me just highlight that for you guys so that you can just see kind of about where it is here. Let me just come back up here, right around this area right here. So we can say right in that area there is anything above, anything below. That's kind of the 2% zone. And you can see we're well below it right now. In fact, we're at our 2016 lows right now on interest rates for the 10-year, which is keeping mortgage rates low. It's keeping all borrowing costs low right now, because most mortgages in the United States are based on the 10-year Treasury note, not the 30-year bond. And you can see just how low this is, and a lot of money is coming in from offshore into this, so we got a lot of offshore people to thank, mainly Europe and Japan. And then the other one that I wanted to show you guys is volatility. If we look at volatility right now, you can see I've got this chart. It's colored. I've got the zones 1 through 5 up in this area here, and you can see in zone 5. Well, let me just move it so you can actually see it, right? So this is, or let me just move it up like that. So zone 5 is black swan events, but let me just show you something here that I find very interesting. We're down beyond the lows made August 24th, but look at how high we got with volatility in August 24th. We haven't had one of those here. We're right here now. We're at those lows. This has been a very orderly move up in volatility. Here you can see we went from zone 1 on this daily chart to zone 5, which is I call possible black swan events, literally in 3 or 4 days. And this was the fastest bump in volatility in a period of time in the history of the markets. So that's what causes a flush out and causes a big bounce back up. Here, we're just petering around here, so it's a very orderly move down. It just does not have that sense of a blow off bottom. Now, some people say until we get that blow off bottom, a bottom really hasn't been made. And that may be true. And you cannot predict when you have one of these kind of events like this. It's just impossible. But there's always some trigger, and the markets are on edge just waiting for something to set the gun off. And it could be news out of China. It could be news out of Venezuela, which has not been mentioned yet by the press. I'm surprised, but they're close to going bankrupt. And if you remember the Asian crisis back in the early 90s, it was set off by Argentinian debt, and just small countries set a contagion effect, and then it moved over to China and then Asian markets, and then boom, it set off a worldwide contagion, and we had a big, huge spike in volatility. So anything can set this thing off. And I would probably agree that until we have a big spike, we're going to just kind of gradually move down a little bit. So that's kind of what I'm seeing in the volatility market. And we're in zone 3 right now, which is a danger zone. And very rarely do you move to a zone 4 in volatility until you're in zone 3. And that's where we are right now. So we've got to be we've got to have our guard up and just, either be more in cash or be allocated to risk off assets or day trading. Because once you get into this zone and this zone right here, primarily in this zone here, day trading rules. I mean, because you can just catch a trend and you don't care whether it's bullish or bearish, that trend's going to run really quick, and you move your stop loss and just trail it, and you can do very well in those kind of environments. Swing traders, position traders, they tend to get killed once you move into zone 3 and 4, because you can have these wide moves, and generally you're going to be on the wrong side of the market, because most people find just being permanently short is a very hard place to be. In fact, if you were like that since 2009, you'd be way underwater. It's very hard to be. So again, strategy-wise for our members, we go through this in a little bit more detail. If you're not a member of our group, I highly encourage you to come on in and sign up. We got a lot of stuff going on. So those are some of the things that I'm looking at. Now, the other thing that is really on our mind, I've been following it very closely, are a couple of commodities. One of them is oil, because oil has been tied at the hip with equities lately. And it's been moving with equities. And as I blow up this daily chart, you can see we've hit targets over and over again. You can see this target here we hit very nicely from this sideways pattern we were in back in the summer of 2015. We were short oil all the way down, and we got out in this area here, and then you can see where you wanted to be was short again, because this was the new target here. Now we blew below the new target, and I'd called it down to around 26 or around the mid 20s, and we came in right at, you know, about 26 and some change on that new target there, 26.19 actually. So now the question is, where are we going from here? Well, we've got the fundamentals of the market say we're going lower. I think the lows have been set. And I do believe we're going to grind higher, but there is going to be a limit to how high we can go. It's going to take at least a year or so to work off these inventory levels. But understand, the last 2 weeks we've been following the oil inventory reports that come out at 10:30 in the morning, typically on Wednesdays, because equity markets go with oil now, almost tick for tick. That correlation is like 98%, but it will not stay there. But for now it is, so we take advantage of it. Watch the oil inventory report. So that's kind of where we're going to be. Now, not this coming Monday, but the following Monday is a holiday for all U.S. markets. It's President's Day, so it's going to be a long weekend. So just jot it down on your calendar for those of you that are going to be trading Friday. Friday's closed. We're not going to open again until Tuesday. Next Friday's closed. We don't open until Tuesday. So anyway, this is where we're sitting with oil. And the other one that I'm following very closely is gold. As you guys know, we've been watching it, and you can see on this daily chart. Let me just put my indicators back on the screen. You can see, and let me just move the new high price of gold right up there. That is the 2016 high right now. You can see the blue line down here is where we opened in 2016. 1061, and you can see the high is 1173, and we're coming up on a natural price level support high of about 1180. I do believe we're going to go much higher than that. I think we're going to be topping that out back up around the 1200 zone. And if you look at this, you can see here on these Fibonacci's, we've got another. If we take out the 1180 area, we got another free run all the way up to around 1270, 1280 area. All right, and you can see the 0.38 fib level here. So I do believe that we've got some more move here. Now, this move has nothing to do with inflation, guys. It's all about fear and a weaker dollar. I do believe we're going to have some great trades in the currency markets in 2016. We're going to have good trades here in the commodity market. In the energy market, we've got some good trades. We got some others setting up on a seasonality standpoint. I'm not going to go into on this free session here, but for our members, I'm going to spend some time this Sunday night on it. I see some interesting things in the agricultural market too. And then let's not forget that on a washout in the markets like this, with a high correlation goes up dramatically when you have a lot of volatility like this in the markets. Here's the E-mini S&P 500, and I'll put all my indicators on the screen. I'll come back into a daily chart. Correlation is very high on days like this, and you can see that I've got a lot of support down here, but I am saying that the odds favor more downside action here for now. But correlations are a lot higher, but we've got some, which means good stocks go down with bad stocks. Now, we saw some technology stocks get spanked last week, LinkedIn being one of them, Amazon being another. A lot of these companies are just getting killed because we don't have the Fed out there promising more stimulus every time the markets go down. And so now when companies come out with their earnings and they miss top or bottom, or they miss forward guidance, they get really punished. Right now, they got to get all three right. They got to hit on the top line, they got to hit on the bottom line, and they got to hit on their forward guidance. Before, when we had that artificial Bernanke or Yellen put in the markets where they were always going to rush in with more stimulus, they didn't have to hit all three in their earnings. Now they do, and that's why they're getting killed. LinkedIn was one of them. So, but there's some good stocks out there that are going down with bad stocks. And we're going to be looking at these when we do find bottoms, because you can pick up some really good companies at discounted prices. All right, everybody, that's pretty much the overview for this weekend's weekly roundup, this free update. Again, for non-members, I highly encourage you to come in. We're growing like crazy. Our chart action's been pretty dead on right now, as we would say in the military, balls on accurate. So let's keep up the work here, and I'll see our members tomorrow night in our Sunday night session. If you're a non-member, come on in and check us out. All right, everybody, have a great weekend, and enjoy the Super Bowl Sunday night. Take care, everybody. Ciao.